On October 10, 2025, 1.6 million people watched their trading accounts die in a single day. $19 billion, wiped out in hours. The biggest one-day wipeout in crypto history. But here's the strange part. Bitcoin didn't go to zero that day. It didn't even crash by half. And yet, total loss for over 1 million people. That's because the biggest mistake in crypto isn't picking the wrong coin. It's something much more ordinary. And by the end of this video, you'll see it. In numbers nobody puts in the ads. Start with a fact that shouldn't be possible. Bitcoin was one of the best performing assets of the entire decade. And still, when researchers at the Bank for International Settlements tracked crypto app users across 95 countries, they found that roughly 8 out of 10 retail investors lost money on it. Losing money on a rising asset takes talent. But it's not talent, it's a pattern. The study found that most people downloaded their crypto apps at the exact moments prices were spiking. Nobody downloads an exchange app when the market is boring and cheap. They download it when their feed is full of winners. In other words, people don't buy the asset, they buy the attention. And attention peaks exactly when prices do. Let's run the honest math on what that costs. In October 2025, Bitcoin hit $126,000, an all-time high, headlines everywhere. That's when the crowd rushed in. 9 months later, it trades around 62,000, cut in half. Now the part nobody calculates. Lose 50%, and getting back to even doesn't take 50%. It takes 100. Your money has to double just to return to zero damage. And the average person doesn't wait for that. They buy excitement at the top, they sell fear at the bottom, and they lock in the loss. The asset recovers. The investor doesn't, because the investor already left. But buying the top only loses you half. To lose everything, you need the second mistake, leverage. Borrowed money that multiplies your bet. 10x leverage sounds like 10 times the profit, and technically it is. It's also this. A 10% move against you, and your entire account is deleted. Not damaged, deleted. That's what October 10th actually was. 87% of the positions that died that day were leveraged bets that prices would keep going up, placed at the very top of the market. The crowd wasn't just wrong, it was wrong with borrowed money. And that was just one day. Across 2025, forced liquidations took about $150 billion from traders. That's not a market working badly. That's a machine working exactly as designed. Because here's the question nobody asks in a bull market. If you're losing, who's winning? Follow the money. The exchange collects fees on every trade, win or lose, and liquidations are their best business. The early buyers, the insiders, the funds, they need someone to sell to at the top. Your FOMO is their exit. Every time you buy on a spike, someone with better information and more patience is on the other side of that trade, smiling. Markets don't create money out of nothing. They move it, from the impatient to the patient. The only question is which side of that transfer you're on. So what do the 20%, the ones who don't lose, actually do differently? It's painfully boring. They only invest money they can afford to watch drop by half without flinching. They use zero leverage, none. They buy on a schedule, not on a headline, so the price of attention never becomes their entry price. And they hold their own coins, because as FTX proved, an exchange isn't a vault, it's a company that can vanish overnight. That's it. No secret indicator, no inner circle. The survivors just refuse to play the game that eats everyone else. The biggest mistake crypto investors make isn't crypto. It's arriving at the exact moment the crowd does, with borrowed money and borrowed conviction. The asset was never the problem. The timing of human excitement is. Markets have run on this one rule for 100 years. Money flows from the impatient to the patient. Pick your side early. If you want more honest math about money, the numbers behind the hype, subscribe. There's plenty more.